Hello, everyone. Welcome to today's session. Let's get underway here and talk a little bit about what's happening in the markets. We'll go long-term perspective first. We know that we're bearish in a bull market currently, with that bull market rank sitting at 22.06, which is starting to decline now. You can see that 22 level. This line is starting to round out just a little bit right here from the last 2 or 3 months of price activity on S&P 500. That's a really slow moving indicator. And so once it starts to get extended like this, it can certainly, as markets are flattening out, this level is starting to round out here as well. We are at the bottom end now of the momentum range. Pretty extreme move yesterday, extending that again today. Breadth also negative. We'll look at some additional breadth indicators, and then also sentiment. Sentiment's still up in that upper complacency zone. As we are still pulling back, we're still in a retracement, just a pullback retracement, not necessarily a full-on reversal, because we have this entire move and now we've just retraced this part of it so far, just a little bit right here. So we could be, it could be sitting into one of these scenarios right here. If we do get a bounce and start to move back up again, then we're going to want to see how that bounce reacts. So we're at a level now, particularly in the buy-sell ratio and sentiment. Let's take a look at those, because we do have buy-sell ratio really extended right here, 0.1. As we know, that can go lower. If I go back, let's go back 3 years and see what that looks like. You can see how much of a spike we've started out with. Okay, so we're already up to some of these areas where we can get reversals, but you can see some of these, some of these bars here, I should say these lines in this case, were way above where we're at right now. And so there is possibility for going even lower than we are right here. But that being said, we're in the range. We're in the range where the red line in this case typically doesn't go too much further. These were, this was the bear market bottom. This was October of 2022, so a year and a half ago, and then we had a couple along the way here, but these are, so these are pretty significant bottoms. In fact, if we go in just a little bit more, let's see if we can pull in if 4 years gives us COVID, and I don't know what we've got on all dates there. I'll go back to 2015. So where was COVID? So that was COVID right here. That just disappeared. Yeah, back here in some of these levels where that keeps going, disappear there. But you can see this one here, this spike, we're sitting right here. This was the COVID bottom. That was that COVID low. So we really just bottomed out, and we did it this really close to the same thing right there. So we certainly can at market bottoms. Those are more capitulation type bottoms. So what we don't want to see is we don't want to see this line really accelerate much further past this area. If we could see a kind of a bit of a pause here, and maybe even a bounce in the markets, that may help. That may help some of the selling that's happening right here. We also have S&P 500 sentiment, which is down now to, in this case, 6.7. That's less than 10. Right around here, this is set at 10. So anything less than 10, we're in that area. We're in that range where, sellers that have sold or probably will have done so, unless we get some type of additional catalyst that may drive the markets lower. That certainly can happen. Let's look at all of the indices. In fact, let's start with S&P 500, because we're sitting right at this support area. There's this support here, which extends over. Also inside of that momentum zone, that Fibonacci 236 area, that retracement sitting right here. S&P is just starting to pull back into that. We have shifted over into this downtrend. And so what that means in most cases is that means an allocation shift. The allocation shift is, do I go 100% cash? Do I go 50% cash? Do I go 80% cash? Or to say it the other way, am I 20% allocated into equities? Am I 50% allocated into equities? Equities meaning stocks, if you're not familiar with that term, but it's essentially, am I going to be invested in the stock market? And if so, what percentage am I going to be allocated towards that as we're working on this retracement right now? Now, I mentioned this, I think it was last in last Tuesday's class. One of the more bullish scenarios is, I'm just going to look at this chart right here just a little bit. As we get this uptrend and this retracement, on this chart, we could see a retracement back down, all the way back down to this support area, and could create a support range, because we've had most of the markets breaking out. They've all had breakouts within this last year, within this last 3 months. So working on a retracement and a pullback could be an opportunity for a bounce to more upside. That's the most bullish scenario, and is we're not there yet. We need to retrace quite a bit more in order to get there. But S&P 500, in fact, if we look at this 1 year time frame, that breakout point puts us back to about a 50% retracement. Okay, so actually, let's go out just a little bit further and see if that 2 year pulled in. And I'm going to just pull this. Let's go back another year, and let's see if we can just get that most recent, or that high that was right here. Here it is right here. So this high is the one I'm talking about. So a retracement back to that 483 range. If we were to look at this, all the way across here. Now this time frame, you can see this time frame in terms of the Fibonacci retracement and the momentum zone. Pardon me, for this time frame is now, it now changed it, right? It changed it because we typically are focused on this 6-month chart. And as we go out a little bit further, now we're grabbing this entire trend, this entire move higher, and a 50% retracement of that is clear back here. Even a 382 is clear down here. So a 236 down to that 483 range is not out of the question. But is it going to happen in one fell swoop, like like something like this? We had some selling back here, and then we got these topping patterns, and then ultimately it did end up retracing. So the first move off of a downtrend, in this case, it was something like this. I don't know if you can see that really clearly, but here, and then some support and a rally higher. That's what, at least as of right now, at these market tops, that's what it's feeling like, is watching for a support area, watching for any pent up demand that now wants to come back into the market and push things higher. If we continue just to fail after fail after fail on the support areas, then that may not be the case. So let's go back to the 6-month time frame here, and let's also look at the NASDAQ 100, which is the triple Qs is the symbol. You can see that support area now. So we're on the other side of this uptrend that's been moving this direction now. We're now kind of on the other side of that. We talk about it mostly in terms of support resistance ranges, this direction, instead of a trend line. We're looking more on these ranges across the board. But now we've got resistance right here. So on NASDAQ 100 for technology, any kind of a bounce, which it certainly could right here, if we were to get a bounce and it would run up, this would now become resistance. So we've shifted trends in the short term as well. And that means that there's more work to be done. Okay? Any market or stock that starts to roll back out of that momentum zone and starts to notch back down, or even in this case, support and resistance zones, that's going to create a major overhead resistance for sellers to start to come back in. And if ultimately that is the new trend, and sellers are waiting around for this to happen and it moves lower, then we'll know. We'll know that pretty quickly when we run back up into this area. And that'll be an area also where we can also make some additional adjustments if we need to, in terms of raising more cash, adjusting allocations. And that's, again, my suggested action is changing allocation, just changing the balance of moving a certain amount from equities back to cash. You can do the same thing in retirement accounts or 401k plans or other long-term investment accounts that you've got, in terms of moving money around and changing your allocation. Now, as we know, in the shorter term, it's a little bit harder to be able to make some of those moves. I should say in the shorter term, it's a little bit easier to make some of those moves. In the longer term, in those long-term allocation portfolios, then that's maybe a little bit different to be able to say, I'm going to adjust my allocation. But you can do the same thing. You can say, okay, inside of my retirement plan, I'm going to have 70, 80% cash. okay, or 80% money market, or 80% short-term, government bonds, whatever the shortest term option, and to remain and to keep it liquid so that you can move it around or utilize it if you need to, then that's the decision you've got to make. I want to go, we've had a big run up, markets could be volatile, they could be moving sideways. I want to hedge, I want to protect myself against that. Well, we know that the main way you can protect yourself is not by participating, okay, or not by participating with a large amount of the funds. Now, if it's longer term money, and it's, invest in America and buy the S&P and close your eyes and sit and wait and then just continually add into it, that's great. That's a great strategy as well. But in terms of the shorter term, the next 1 to 3 years, then what do you need this pie of money to do for you? If you're utilizing equities to try and get some growth and some gains, then that certainly can happen. That's a high probability. But now as markets are retracing, that allocation may need to shift. And the only thing that's shifting with your allocation is your ability to handle risk, your ability to handle market drops or market volatility. We're getting volatility in this portfolio. It's down about 6 or 7% so far this year, off of the highs at about 37%. So, a 5 or 6% drawdown, 7% drawdown, overall, that's the amount of volatility I'm willing and able to participate in pardon me, in this portfolio. Is I don't want to be really aggressively allocated, but at the same time, I want to be able to participate in stocks, knowing that market tops oftentimes create scenarios like this. Everything just gets tossed. Good stocks, bad stocks, everything. It's a tougher environment to trade in. It's a tougher environment to hold on to winners, because a lot of stocks just continue to drop back down again and then get stopped out. So it enhances volatility. Market pulling back is going to enhance the volatility, no question. We had that long-term trend that we just experienced. Those are great when they're happening. Okay, everything flows, things are going. The last 2 or 3 months, things are kind of topping out. It's a little bit tougher scenario. So that again, that you've got to know yourself, and you've got to know how you can manage and how you prefer to manage the risk. And that's typically in our case with position size and with stop losses. For position size being, ADCT, which is a new trade today, 1.3% allocation. It was a really small trade. Okay, so now as trades are getting a little bit smaller, we got a couple in there just that are a little bit bigger, because that's one of the winners now. So it's going to be kind of a quiet time, kind of a volatile time right here, but it's going to be interesting to see what my experience in the past has been, that when these market conditions start to happen like this, and they start to fail, it's really easy to just sit and wait for the bounce. And then it's like, well, we didn't get a bounce, and it slides through here. It's like, well, we'll eventually get a bounce. By the time we get a decent bounce, we've already moved up over, and maybe we've already started to trend back down again. So these are, in terms of picking the top and saying, yep, sure enough, this is the top, we're out, I'm done, I'm moving to cash, or I'm going aggressively to the downside. Some people have that skill, and that may be a management strategy as well. But for most of us, it's about managing the risk associated with the kinds of holdings that we have. And that's percentage of the allocation that we're dealing with. That being said, short term, we're extreme. What do we know about extremes? They don't last. Okay, so extremes, that's why they're listed right here, is when we have these extremes. The reason why this is green and this is red is because this is saying reversal risk is extreme, meaning that it's bullish reversal risk. It's green. The reversal risk is to the upside. It's really not risk, I guess, but it just means that it's the chances of it continuing down are getting less and less, because the momentum is too extreme. That balance of power is going to shift at some point. It's going to start to cause some support, and then it's going to shift, or it's going to move back up and head lower, or it's just flat out going to head lower. We're going to find out, within the next few hours and tomorrow, and then into Monday as well. But this area is extreme enough to the downside that I would say, let's watch and wait for a bounce. And if we get a bounce back up into these levels, that'll be another area to sell into, to lighten up some of the positions that we may have in a downtrend, in a downtrending market. Okay, so again, these are the times, the last 2 weeks, 3 weeks, we've been talking about this quite a bit. Now is the time to make those adjustments that you feel like you may need to, only because we still have massive headwinds. The Fed has not got this figured out. The interest rate, the issue is a problem, and it's going to become a problem even more so this year in the real estate market. If we get recession, if the economy slows down and we get layoffs and housing prices are high and no one can get a mortgage or refinance, that's going to create some additional drama in the economy. But the Fed wants that. They kind of want to break everything, and that's got to, in order for them to slow the inflation, they've got to break things, and that's what they're working on right here now. So we're starting to see the market realize that, hey, this is not going to change anytime soon. Inflation is still high. Fed's not, they're not budging, and they probably won't. So let's take a quick look here at bonds as well and see. We did see a little bit of a move yesterday, but coming back down some today. This is the TLT, which is the 20-year long-term bonds, and just continuing to slide back down again. Interest rates are staying where they are, to a slight increase. SHY also here to the downside, but some potential some support. Let's go out just a little bit longer term on that and see. So the 1-year time frame on that switches us over to a downtrend, and we're just about back down in the short-term yields, back down to that bearish momentum zone. Now, remember one thing with interest rates and bonds. Well, in this case, interest rates, as they are rising and falling, the bonds are also rising and falling. So it's a quick way to be able to look. We're right back to a potential long-term support area where we were at before in bonds, before the Fed started doing things. So this whole discussion about what's happening, when they're going to do, they haven't done it. They haven't done anything. So this is the bond market saying you haven't done anything, and you're probably not going to do anything. And so this was an anticipation of that. Equities are starting to embrace that, it seems. Sectors, we're also seeing some significant sectors to the downside, really almost all of them now. Energy, utilities, the last that are kind of holding up right here. Everything else sliding. I also pointed out the buy-sell ratio across some of the indices this morning. S&P 500 buy-sell ratio is at 0.05. That's really, really low. Okay, that's 287. It can go lower because some of these hold stocks can spill over into more sells. So this can go lower, but this group of stocks that are stuck here in this hold range, they can pop back up. We can get a rally and jump a bunch of these back up, and this will move back up, or they can bump back down. But right now, pretty nasty actually to the downside as far as breadth. What's interesting is price doesn't feel like that. It just hasn't been. We haven't seen any real like spooky kind of intense down days. They've been relatively orderly, and for whatever that means, it means that we're still in an uptrend. And there's just not a lot of huge demand, a lot of huge excitement on selling. I think there's a lot of rotation on shifting, money moving around into different sectors, money moving into cash, portfolio rebalancing. A lot of things like that are happening for some of these big institutional funds that have got to start to make some shifts when, based on interest rates and inflation and the Fed and so forth. Let's jump over and look at a few different stock ideas for today. Again, you're always going to have new stocks in the new buy list, and we had a few that continue to move higher. We're seeing in that new buy list, we're seeing some of the same ones. Cameco, which is a uranium miner, Dorian LPG, which is a natural gas shipper, Murphy Oil. Delta Airlines actually had a decent little move higher. Let me go into that 6-month time frame. So Delta in this tight range, running into some resistance, but still moving higher. Interesting that airlines still moving higher. We're seeing some gold stocks in there as well. So you're seeing which ones of these are currently leading. You've got Freeport, which is another mining stock. basic material stock. Those basic material stocks took off so quick, and here's another gold, Alamos Gold, and they went straight up for a little while. Which one did I just see right there? Oh, silver, mag silver. Silver also having a big move. So keep an eye on a lot of these miners that are working like this. In fact, we own 3 of them currently in the portfolio, where we've got, and I think all 3 of them are some of our winners currently. HMY, which has got some support in there. We bought back on this buy bar right here. So it's just been kind of floating higher, moving higher, trending higher. In this case, 30 some odd percent. And I'm sitting right here. Okay, so I keep doing that. USAP, which is a steel producer, also working, moving higher. So you're seeing different groups of stocks that are continuing to move higher: the basic materials, the miners, the oils, the golds, and we've had a few that have made attempted moves and couldn't quite hold up on to. I don't know why things end up running so slow for me at this time of day, but less. Keep an eye on some of those in that new buy list. Also muscle ETFs, and that'll give you a good idea of what's working, what's continuing to move higher in these market conditions. And if you're still venturing in, which we're still venturing into some of these trades, because we're going to get some that do continue to work. We're going to get some that stop out. So again, you don't have to do it the same way in terms of the new buy portfolio. It's just simply managing a group of stocks in a way that is systematic, so that you know what you're looking for and watching for: your entry, your stop loss location, continuing to trail that stop loss higher, and then letting it run as long as it possibly goes to. For example, let's go back to HMY. Maybe we won't go back to HMY. Let's look at one of these other gold stocks and see. So for example, in HMY, what we're doing is, and in the other gold stocks as well, is using the 236 as a trailing stop loss. Okay, so let me just rewind this price pattern for just a minute. I'm going to go back out to about a year. I am struggling today. Oops, didn't want to do that either. I wanted to go to 1 year, and so is my data. It's my train of thought. Sorry, I'm a hot mess today. Okay, here we go. Gold mining. If we take this price pattern, and let's say that we bought into this stock right here. Okay, we bought in right here. We had our stop loss below this bar, and as this either moves higher or lower, okay, we've got a stop loss in place so that if it moves lower, we're exiting out of that trade. We don't know if it's going to continue to move lower or if it's going to bounce and head higher. We just have to make sure that our initial risk, we've defined that. We exit at the place that we're going to exit, and we can always re-enter if we need to. But in this case, as the stock moves higher, so it's jumping higher, notice what this 236 line is doing. Okay, it's moving higher, it's moving higher. You can use that as a trailing stop loss or just below that. Okay, because you can see oftentimes it'll tag that, it'll touch that area. We've had 2 or 3 that have touched it just below that and stopped us out and then moved higher. But I would rather do that in some cases than, because it's about half and half. The ones that touch it and stop you out and then move higher versus the ones that touch it, stop you out and then move lower. Okay, so it's like just follow a rule so that you're doing the same thing each time. So in this case, that's an easy way to say, and by trailing the stop loss, what you're doing is, as the stock moves higher, okay, you have your risk level set here. Now it's moving higher. Once it is moving higher, it retraces and then it's going higher. We can adjust that stop loss, and that 236 is always trailing. Okay, so at some point it's going to become the high water mark. This high water mark, that Fibonacci tool is going to grab onto it, and then it's going to start moving its way back. Once it starts moving its way back, that's when we want to make sure that we're using a trailing stop of some kind. This is just a suggestion. It's an easy way to look for where those support resistance zones need to be, and where my trailing stop needs to be. And it's just always going to pull it higher until it reverses. Okay, so as long as that uptrend stays in place, that line is going to move with the chart pattern, and I can adjust my stop loss there. Now, if you don't like the chance of getting stopped out, we've had 3 or 4 that we've been stopped out of, and then they've moved higher. Then set your stop either at a round number between these two, or go all the way to the 382 and use your trailing stop as a 382. If you do that, remember the 2 things that you have to control are your position size and your stop loss. So if I'm managing, let's just go through an example. Let's say that say that I'm buying this stock today, okay, and I'm going to buy 1,000 shares of it, and I'm going to have a stop loss right here at $3.40. So $3.40. That puts my risk in this trade at 0.23, which is less than 0.3, which is the number I prefer to utilize. Okay, so my risk is fine. I like that number. If I wanted that's a pretty big position size though, right? 3.4% of 100,000. That's a pretty big trade. 3,600. If I want less than that, then I've got to come down now. Okay, I've got to come down to 800 shares. That's still a little too high. Let's go down to 600 shares. Now I'm at 2%. Okay, so 2%. And if I include my stop loss at 3.4, now I'm at $144 at risk, or 0.14 of my entire portfolio. Okay, now notice in order for me to keep the stop where I wanted it and have an acceptable level of risk, I had to manage the position size, which makes this trade really, really low risk in terms of the amount at risk, okay, if that makes sense. So if I wanted to increase that number, or if I could increase that number, it depends on which one I'm focused on. If I want to focus on this number, which I always should focus on this number first, how big is the overall trade going to be? Let me highlight that. How big is this going to be of my entire account? 2,000. How much of that is of my current balance? So in this case, it's 2.09%. I always want to know that number first. So you just leave the stop loss blank, and then now you know, okay, I'm 2%. Worst case scenario, this thing drops to 0. I'm out to 2,000. Okay, if it drops 50%, I'm down 1% of my full account. This is position sizing. Okay, it's called position sizing, where you're determining the size of the position. You're determining the size of the trade, or the size of the holding, size of the stock, the size of the amount that you are allocating, the slice of the pie, so to speak. Okay, the slice of the pie. So in the portfolio, this is position size. Each of these are my position size, and that's what I'm managing. And notice this slice of the pie is 3.32. That's a bigger position size than ADCT, which is 0.13 or 1.33. That's a smaller position size because it's just a smaller amount. Okay, that's how we're managing the risk. So right now, I could say, in order for me to manage the risk of USAP, it's a winning stock, and I don't want to sell it too soon. But if I got to that point that it said that's too big of a position for the risk that I'm willing to take, I don't want to give any of that back, then I could sell some of the positions, sell some of the shares, and move that 3.32 number down, maybe back closer to 2% or 2.5%. The way I would do that is sell that 150 shares, maybe sell 50 of the shares, or maybe sell 40 of the shares. Okay, I'm making this slice of that pie smaller. Okay, and ultimately the risk is going to be, here is my cash position. The more positions we take, and the more winners that we end up having, then we end up with more positions. During that last run up higher, we had about, I think it was 30 positions at one point, all the way up to here, and then this much cash, because the trades were working. We weren't getting stopped out of anything, and we were adding into new positions each day. So naturally, we've had some stop outs. We've taken money off the table. We've lowered the risk to kind of get us back to around this, 25% to 30% allocation of equity holdings in this case. So I'm going to end on that note. I appreciate everyone's time and effort, and we will see you all next week. Have a great weekend. Thanks a lot. Bye now.